it's actually alarming, and it's starting to alarm a lot of at least some of my peers that are still in the, like, fund world, um, because it's exactly like that. It's not sustainable at all. Let's go over some of the pieces of the puzzle here. So, yes, prices keep coming in. We did get one report this week that said that savings is at an all-time low and that debt is starting to accumulate. So that's not very sustainable, as we know, right? We also got a report this week about the US. It's called the debt to GDP ratio. And, historically, having a debt is not a bad thing because, just like how credit card companies, in order for you to build a good credit score, being able to manage debt is okay. But when your debt is greater than your annual income, that starts to be a problem. So, for instance, the US came in at 120%. Historically, that sweet spot was about 70 to 80%, right? And so the fact that our debt is 120% of our GDP here at the US, that's not considered sustainable. It's like the can is being kicked down the road for future generations. You've probably heard that a bunch of times. But when you compare it, look at Italy, right? Italy with their aging population, their debt to GDP ratio is 170%. Japan for the longest time had GDP ratios almost near 200% of GDP. So, is that a measurement? I don't know, but just, historically and, when you do the math, how can you continue to have this much debt and not have that big of an economy? So that's another data point. Another data point is just, you know, sadly, the hedge fund managers out there still refer to retail money as dumb money, right? Not as much as they had, right? I think they got a good shaking out when it came to the GameStop and the AMC theaters run up by just run of the mill retail investors kind of getting together on things like Reddit and YouTube and other socials. But still, we're seeing a lot of retail money jumping into the market as if they're afraid that they're going to miss out on something. And, hedge fund traders, besides being a little bit alarmed, they are looking for strategies on how to get that retail money into their coffers because that's what the markets are. Despite what a lot of folks out there interpret from, especially the talking heads that'll go on a TV show or on a radio show and start, yelling about how much money was created or destroyed in the markets. All the markets are places where money changes hands, and traditionally uh, these fund managers have been able to figure out how to get the money from, you know, beginner and novice retail investors that gets peppered into the market into their coffers, right? And so there's that, right? There's an inordinate amount of retail money going into the markets right now, dumb money, right? And finally, we've got this pattern coming on here where indeed we're at the tip of our pivot. And you and I drew this pattern about 2 or 3 weeks ago, and we extrapolated out this pivot point to Monday. And so, next week, I'm expecting something to happen. I don't know if the dam will break, SIP, or what, but I'm expecting something to happen in the form of some sort of breakout up or breakout down. And if you look at my chart, this level of resistance has held pretty well. It's the level of support that keeps getting tested, right? It got tested back in the beginning of January, and then a little bit later, around January 17th, it got tested on January 31st. In fact, it got tested this past Monday. And so I'm almost certain that we might be starting to get ready to finally see this overbought market correct itself.